Welcome back to Synaptic Dividends. We break down a new dividend stock often to help you build your passive income portfolio. If that's your goal, make sure you're subscribed so you don't miss out. Now, today, we're looking at a healthcare giant, Becton Dickinson, or BDX. They're a dividend king, but one key number looks, well, a little scary. So is their legendary dividend a rock-solid investment, or is there a problem hiding in plain sight? Let's dive in. Okay, let's just get this out of the way. Increasing your dividend every single year for 53 years is absolutely legendary. That kind of consistency builds a reputation for being this unbreakable fortress for income investors. But reputations are built on history. We need to know if that fortress is still strong today. So we're going to stress test the numbers and see if we can find any cracks. All right, so let's start with our first piece of evidence. This is the most common metric people use to judge if a dividend is safe, but in this particular case, it's also the most misleading one.
And that metric is the Net Income Payout Ratio. It's actually pretty simple. It just takes the company's official on-paper profit, what they call net income, and it calculates how much of that is being paid out to us, the shareholders, as dividends. It's always the first place most people look.
And for BDX, that number is 76.1%. Whoa! A number this high is an immediate yellow flag for most analysts. I mean, a payout ratio over 75% suggests that pretty much all of the company's reported profit is being used just to pay the dividend. That leaves very little room for error, or for reinvesting in the business, or just handling a tough year. So look, if we stopped our analysis right here, we'd probably walk away thinking, yikes, this dividend is stretched way too thin, it's risky. But that would be a huge mistake, because this number, it's not the whole story, not even close. To find the real truth, we need to follow the cash. And this, right here, brings us to the most important part of our whole analysis, the real cash story. Because, accounting profits can be tricky, but cash doesn't lie. So now we're going to look at the free cash flow payout ratio. The easiest way to think of this is like the money left in your wallet after you've paid all your bills and all your necessary expenses. For a company, it's the actual cash profit they have left over after running the business and investing in its future. This is the real pool of cash that's available to pay dividends. And this one comparison tells you everything you need to know. While that net income payout looked really risky at 76.1%, the free cash flow payout is a much, much healthier 46.7%. What this means is that BDX is using less than half of its actual cash to fund its dividend. That is an incredibly safe level that leaves tons of cash for paying down debt, making acquisitions, and of course, continuing to grow that dividend. So you're probably asking, why is there such a huge gap between these two numbers? Well, it's mostly due to accounting rules, of all things. See, after BDX made these massive acquisitions like CareFusion and CR Bard, they had to record huge non-cash expenses. These are just paper write-downs. They make the reported profit look smaller, but they don't actually drain any real cash from the company's bank account. The cash is still there. Okay, so the cash flow tells us the dividend is safe right now. But what about the company's long-term commitment? I mean, can we trust them to keep it up? This is where 53 years of history provides all the proof we need. 53. Just think about that number for a second. For 53 consecutive years, BDX has not just paid, but increased its dividend to shareholders. This track record is so elite, it earns the company the title of Dividend King, which is a club reserved for companies with over 50 years of consecutive dividend growth. This isn't just a policy for them, it's a core part of their company's identity. A long history is one thing that's really impressive, but the ultimate test for any dividend is how it performs under pressure. So what happens when the entire economy is in a freefall? Can it handle a real crisis?
Just look at this. During the two biggest economic stress tests of our lifetime, BDX didn't even flinch. In the depths of the 2008 financial crisis, they didn't just maintain the dividend, they raised it by nearly 12%. And then again, during the global pandemic in 2020, while other companies were slashing their payouts, BDX delivered another increase. This is the ultimate proof of a resilient business model.
So, we started with a number that looked like a big red flag, but we followed the cash and we checked the history. Now it's time to put it all together and deliver the final verdict. Let's recap real quick. First, the dividend is extremely safe, covered by a free cash flow payout ratio of just 46.7%. Second, the company has an ironclad 53-year history of raising its dividend every single year. And third, it has proven time and time again that its dividend is crisis-proof, growing right through the worst recessions we've ever seen. So, was Becton Dickinson's dividend hiding a problem? The answer is a clear and simple no. The numbers show a safe, resilient payout that is backed by real cash flow and a legendary half-century commitment to its shareholders. That initial scary number was nothing more than an accounting illusion. So the final takeaway here is that behind that one misleading number lies this incredible story of stability and reliability, which really just leaves us with one question for you to think about. Is this the kind of crisis-proof stability your portfolio needs? If you want to go deeper and understand the full business model behind these numbers, check out our long-form podcast analyses on our main channel, Synaptic Investing. And of course, if you found this breakdown helpful, a like is always appreciated, and subscribe for more dividend analyses. Thanks for watching.